Hey Fanshawe, it's me Julia, and I'm coming back at you with another financial literacy video. This time we're doing something a little different. Instead of a single topic, we're going to do a breakdown of the terms and practices of the financial industry, so that when the next time it comes up at a party, you aren't just politely nodding along. And if it's not coming up at a party, maybe go to a different one, because it probably means I'm not there. All right, let's start with some accounting terms. Assets, what you own. This can be a car, investments, a house, or it can be prepaid expenses like insurance. The opposite of this is liabilities, what you owe. So basically your loans. Line of credits, mortgage, credit cards, they're all listed under here. This leads to your net worth. Your assets, what you own, minus your liabilities, what you owe. Your net worth can be positive or negative depending on how much debt you have. Some other terms include balances. This term comes from balance sheets. What it means is that your assets equal your liabilities and your net worth. It just means that everything is accounted for. There's income, which is money coming into your pocket. This could be from a job, interest on investments, or if you're lucky, a lottery win. Revenue is another one. This is earned income. This term is used in business to describe the money they earn in exchange for a product or service they provide. And finally, expenses. This is the money you spend on items that you won't see again, such as insurance, food, rent, all of those lovely things. Alrighty, moving on to one of my favorites, credit. Let's start with the basics. There's the borrower, so the person who takes out the loan, and the lender, who is the person who is providing the loan. And then there's also the principal. This is the original amount of money borrowed. Most loans come with interest. We covered this in a previous video on credit, but let's go over it again. Interest is the money it costs to borrow from a lender. There is simple interest, so that's the same amount taken from the principal each time. For example, 5% on a $100 loan would be $5 each time. And then there's compound, meaning you pay the full amount owing, not just the principal. This means you're paying interest on interest, and because it sounds worse and it costs more, this is the most common form of interest in the industry. Moving right along, let's get to the opposite of loans, investments. Here, a lot of terms will start to blend together, which is good because you've been paying attention, right? Investments are essentially you providing your money to another institution, but this time you're acting as the lender. Naturally, this means that you get interest payments, and this time you like that they're compounded. Let's start with registered plans. These allow your savings to grow tax-free. These include TFSAs, RRSPs, and RESPs. Don't worry, I'll go more into depth on these in a later video. Also, a lot of people have trouble with mutual funds. These seem tricky, but they aren't that difficult to understand. Basically, by investing in a mutual fund, you are pooling your money for stocks, bonds, and any other type of investments. These funds are managed by professionals and range from low to high risk tolerance. Think of being a player on a team and the fund manager as a coach. You're all looking to win, and you're trusting the coach's judgment to do so. These funds are broken down into units that you can own, called investment units. Very original, I know. So, if a unit costs $500 and you have $1,500 invested, you have 3 units. Then, what everyone gets excited over, stocks. To put it simply, companies issue stocks to gain capital, money. And when someone buys their stock, they own a small part of that company. As you buy more, your ownership stake becomes greater. These are bought and sold in stock exchanges. However, robo-advisors are changing the game for your access to these investments. More on that in my investments video later on. Lastly, let's talk about banks. Let's start with your bank account. This is where you hold your coin. You can have a few different accounts, but the most common is your checking, where you withdraw and deposit on a regular basis. You should also have a savings account where you can deposit money, but won't often withdraw from. Make sure to look through the details of your plan when you sign up. Some plans may not have a monthly fee, but they often have strict rules about how many transactions you can do in a month and how many e-transfers you can send. If you go over, it adds up really quickly. Trust me, I switched to my bank's premium student plan for about $5 a month because I got dinged on fees whenever my TIMS run went a little bit over, like an exam season. You may also have heard of overdraft. It's when you have more money coming out of your account than you have in it. So if you haven't caught on already, there's a fee for that. Some plans have overdraft protection, but they're generally in the premium plans. And also, if this is happening every month or close to that, it means that you are consistently earning less than you are spending, creating a really unsustainable cycle. If you need help, you're always welcome to book an appointment with me to create a budget and look at how we can make your coin stretch a little further. And that's about it for this video. Please let me know if you think I missed anything. My contact information will be on the screen. Thank you so much for listening, and I will see you on the flip side of exams, I hope. See you later, Fanshawe. Have a good one.